Welcome back to Decoded Fin. I took some time off, but today we're going to examine the core processes companies use to plan their financial future. We'll break down how businesses structure long-term strategy, short-term budgeting, cash management, and forward-looking financial statements to support informed decision-making. Let's begin. Have you ever stopped to think about how companies actually map out their financial future? Not just covering next month's bills and expenses, but planning years ahead for growth, investment, and long-term stability. In this segment, we'll walk through the financial planning process step by step. It's the framework businesses rely on to maintain this stability, protect profitability, and make more informed decisions. And as I've stated, we're going to break this down in clear, straightforward terms. Think of financial planning like planning a road trip. You have the long-term plan, the big map showing where the company wants to go over the next 2 to 10 years. Then we have the short-term plan, the GPS giving step-by-step directions for the next 12 to 24 months. The long-term plan sets the destination, and the short-term plan keeps the business from running out of gas along the way. Financial planning rests on two key pillars. We have cash planning, and this is all about timing, when cash comes in and when cash comes out. The main tool here is the cash budget, or the cash forecast. Then we have number 2, profit planning. So this is about performance, whether the business is actually making money. Profit planning relies on 2 forward-looking statements. Number 1, the pro forma income statement. Number 2, the pro forma balance sheet. And cash planning keeps the lights on. Profit planning keeps the business growing. Depreciation confuses almost everyone, but it's simple. Depreciation is not cash leaving the business. It's just the IRS letting companies spread the cost of an asset over several years. Under MACRS, assets are grouped into property classes, each with its own recovery period, and this determines how quickly the company can depreciate the asset for tax purposes. Why does this matter? Well, higher depreciation equals lower taxable income. Lower taxable income equals higher cash flow. It's one of the biggest reasons accounting profit and cash flow are not the same thing. If you want to know what's really happening inside a company, look at the statement of cash flows. It breaks down cash movement into 3 buckets. Number 1, we have operating activities, cash from running the business. Number 2, investing activities, cash spent on long-term assets. Number 3, financing activities, the cash from borrowing or paying owners. Analysts love this statement because it shows whether the business is generating real cash or just accounting profits. Then we have free cash flow. So FCF is the amount of cash available to pay creditors, pay owners, reinvest in the business. Investors obsess over free cash flow because it drives valuation. The cash budget is the short-term tool companies use to avoid surprises. It starts with a sales forecast, then estimates cash receipts, cash payments, net cash flow, ending cash, and financing needs or any excess cash we may end up with. If ending cash falls below the minimum required balance, the company needs financing. If ending cash is above the minimum, the company has extra cash to invest or pay down debt. Because the future is messy, companies use scenario analysis in order to judge this, or simulation to test best case, worst case, and everything in between. Now we have pro forma financial statements, starting with the income statement. A common method is the percent of sales approach. This looks at past relationships between sales and expenses and applies those percentages to forecasted sales. But this assumes all costs are variable, which isn't necessarily true. And so a better method separates these costs into fixed costs, which costs that stay the same, or in variable costs, which costs that are changing with sales. This gives a more realistic picture of future profits. Then we have the pro forma balance sheet. Companies often use the judgmental approach, so they make estimates in key accounts for the pro forma balance sheet. They use external financing required as the plug figure. If the plug is positive, the company needs outside financing. If it's negative, the company has extra cash to repay debt, repurchase stock, or increase dividends. Why pro forma statements matter? So, pro forma statements help managers forecast profitability, plan financing, adjust operations, set short-term goals, and evaluate whether the company is on track. They're not perfect all the time. They rely on assumptions, but they're essential for steering the business. Essentially, financial planning isn't about predicting the future perfectly. It's about preparing for it intelligently. Long-term plans set the direction, short-term plans keep the business moving. Cash planning protects liquidity, profit planning protects performance. Pro forma statements help managers make smart decisions before problems happen. This is how companies stay financially healthy, one plan, one forecast, one decision at a time. If you're enjoying Decoded Fin and want more plain English breakdowns of complex finance topics, hit subscribe and share the video with someone who wants to understand business like a pro.